This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
In this chapter we look at forecasting techniques, and this is immensely important in any sort of planning or strategic enterprise which an organization might be undertaking. If you're thinking of putting up a new factory, then you need to be able to forecast what the sales and costs are going to be. You might put them into a net present value calculation. If you're thinking of opening in a new country, again, you need the best forecast you can get about your sales volume, the costs, the revenues, maybe even the exchange rates. If you're taking over a company, you'll be looking at that target company's forecast, because presumably what you're going to be paying will be largely based on the future earnings of that company, which are themselves based on some sort of forecast. The techniques that we're going to be looking at are linear regression, and associated, and very importantly associated with that, are the coefficients of correlation and the coefficient of determination. We're going to look very, very briefly at time series analysis, and then we're going to look at expected values and more complicated expected values on decision trees. So first of all, let's look at the linear regression. And linear regression is a mathematical way of fitting the best straight line you can, hence the name linear, the best straight line you can to connect two sets of variables. So you could maybe have the volume being produced, and you could have the cost of production. You'd expect to be some sort of relationship between those, and linear regression will give you the best linear relationship it can between those. It might be the price that you're charging for a product and the sales volume. There, as the price goes up, the sales volume will probably go down. And if you're going to be able to forecast revenue in the future, if you can get some sort of relationship between price and volume, then that's going to be helpful. And linear regression, again, gives you the best linear fit it can between those variables. It'll give you constants which fit the following type of line here. Y equals ax plus b. Well, y is the dependent variable and x is the independent variable. So if you're dealing with cost and volume, what you actually control is the volume. That is independent, but then dependent on that, what comes from the volume is the cost. If you're looking at price and volume of sales, then what you control is the price of the item, and what results from that, the dependent variable, is going to be the volume which is demanded by your customers. Here we can see that if x is naught, so let's say that this is the cost, let's say this is the volume. This is essentially saying that when the volume is 0, this term will disappear, and you're still left with a cost there. That will be the fixed cost. B in this situation would be the fixed cost. Every item by which you increase the volume, as x goes up 1, 2, 3, 4, 5, you're increasing the cost by an amount A, and in cost volume, A would essentially be the variable cost per unit, or the marginal cost per unit. Every extra item made produces that extra cost, causes that extra cost. The trouble with linear regression is that although it's mathematically very sound, and of course is relatively scientific, it will give you the best straight line it can through any set of points. So I could feed in your birthday in terms of your year, I beg your pardon, your day, 1 to 365, and I could feed in against your birthday the last 3 digits of your mobile phone number. And you feed that into a linear regression formula, and it will give you the best connection it can between the day of the year in which you were born and the last 3 digits of your mobile phone number. Obviously, there's going to be no connection whatsoever. They're effectively random events going on in there. But linear regression will come out with an equation of the form y equals ax plus b. And the danger is people believe it. So what you have to do is to test this relationship between the two variables. How well associated or connected are they? And this is what's done through the coefficient of correlation R. In any exam for strategic business leader, almost certainly all the calculations will have been done for you. What you have to do is to take the calculations of the regression line or the coefficient of correlation, and you have to use those. And the purpose of the coefficient of correlation is to make you sufficiently skeptical and questioning about how much you can actually rely on the line. The more points you have, the better. In a way, any fool can put a straight line through 2 sets of points, but if you've got 20 set of points and the line goes almost perfectly along those 20 set of points, then you've got what's intuitively quite a strong relationship between the two variables, quite a strong association as it's called. Extrapolation is dangerous. Extrapolation is projecting outside the area you've actually looked at. So let's say the maximum volume per month you've ever produced is 5,000 units, and you're using your line of cost versus volume to try to predict what the cost might be at 8,000 units, way above where you've actually looked. Then you're going into an area for which you've got no kind of experimental data whatsoever. How do we know that as you go from 5,000 units in the week to 8,000 units in the week, costs suddenly don't start to rise very steeply? You have to pay more overtime. You have to go to more and more expensive sources of material to get enough material to produce those extra 3,000 units. Interpolation is much safer. If you know what the cost is at 4,000 units and you know what the cost is at 5,000 units, it's probably pretty safe to estimate then what the cost is going to be at the midpoint, 4,500 units. The cost is unlikely to kind of spike up or fall down in a peculiar way in between those two outputs. Other known influences should be taken into account. So if you're looking at production, say, in 2015, 16, 17, 18 and 19, and you've got the volume produced in those years and the cost for those volumes there, if inflation is running away at 10% per annum, then of course, if you're going from 2015 up to 2018, a substantial increase in the cost is going to be because of 3 or 4 or 5 years worth of of inflation at 10%. And we need to strip out that known variable. Even good correlation does not prove cause and effect. So association does not prove cause. For example, you could have a sales manager saying, look, every year I spent more on advertising. Every year the volume of sales goes up. Therefore, my increase in advertising is causing an increase in volume of sales. That might be so, but it might be coincidental. The increase in the volume of sales might be because the economy is booming. And nobody actually pays any regard whatsoever to the advertising. It's a waste of money. So just because two variables move together does not mean that one causes the other. It is consistent with that explanation, but it does not prove it. A time series. A time series is where you plot out, for example, month by month or quarter by quarter or year by year, how, for example, sales move. And what we are typically looking for is something slightly more sophisticated than just putting a straight line through. If we take sales for kind of spring, summer, autumn, winter, if it's sales of, say, clothing, then you expect there to be different effects on the sales from the literal season, the weather season, if you like. So if you're selling swimming trunks, then spring and summer, the sales are likely to go up. Autumn, winter, the sales are likely to go down. And you get what's called a seasonal variation. To make use of this, what we need to do is to separate out what's called the trend. In other words, there's an underlying increase or decrease in the sales, and the effect kind of superimposed in that from the seasonal variation. If you can separate these out, then if you are asked to predict, well, what's sales going to be in summer a year from now, or in autumn a year from now, you're going to be getting a much better prediction, because you predict the trend and then you say, well, this is spring, I'm going to add a bit to the sales because it's a popular season, or this is autumn, I'm going to decrease sales predicted by a little bit because it's a very dead season for my sort of product. There might be what's called cyclical variations, very long-term, slow variations, really as the economy goes up and down. We don't predict those. And random variations are beyond prediction anyway. Those don't come into it. All we're going to say is here, basically, if you had your sales, it would be nice to if we could predict what the trend is going to be, going up kind of nice and smoothly. And then we can say, well, in one particular season, it seems to be doing well. In another particular season, it seems to be doing badly. Then what we can do is kind of to try and predict how in the future this variation is going to go on, so we can make more accurate predictions in the future about good seasons and bad seasons. I don't think you need to know any more than that for this exam. It's really just in a way saying that pretending this is going to go on straight, as linear regression would say, is going to miss out these little bits of detail here that might be worthwhile in more accurately predicting what sales in the future or costs in the future are going to be. Expected values. It must be true to say that when we're predicting the future, we are not certain what it's going to be. And expected values are used as a computational technique when we are willing to put probability or odds on what the future holds in store for us. So here, for example, we have a couple of projects, and we've got two outcomes. For example, it could be two economies. It could be a very weak economy, for example, outcome 1, or it could be a very strong economy. Or it could be that outcome 1 represents a very unpopular product which we begin making, and outcome 2 represents a very popular product that we're going to be making. We've estimated, and this could be difficult, that the probabilities are even, 50-50 or 0.5 for each outcome or state of the world. We have there what's going to happen. So weak economy, strong economy, different net present values. And then what you do is you multiply the probabilities by the outcomes in each case and add it up, and this gives you the expected value. We have another project here that's been set up really to give you the same expected values, very different outcomes, same probabilities. The economy is going to be bad or good with the same chance, and again multiplying through here is going to give us the expected value again. A couple of things to be wary about when looking at expected values, especially if you're going to be using them to make judgments about the future, whether to go into a particular country, buy a machine, develop a particular product. First of all, these are usually once-off projects. And in once-off projects, it is rare that the so-called expected value is actually expected. For example, if you take project 1 here, the expected value is 6,000. But actually all we expect is either 1,000 or 11,000. Never in our wildest dreams have we forecast that 6,000 are going to come up. So we're using a figure here, the expected value figure, to make decisions when we know that figure is not actually going to arise. And it's surely just a little bit peculiar, to say the least, that we're basing our decisions on these slightly false and manufactured expected values. Second thing to worry about, apart from it being very difficult to estimate these probabilities here, is that once you've got expected value, you have eliminated information about risk. For example, if this project which we were doing, let's say, had a cost of 4,000, and this here was the income coming from the project, then with project 1, with an expected value of 6,000, there's a 50-50 chance that we're going to lose 3,000. We spend 4, but we only get 1,000. And losing 3,000 that's in there could be deadly to the company. But that's not really recognised in this 6,000 we're getting in here, which looks really pretty rosy. On the other project, if you look at it, there is no prospect whatsoever of losing any money, assuming our predictions are right. The worst case scenario, 5,000, is still going to yield us 1,000 profit. So risk is obscured or lost when you do expected values. And we could easily have changed the figures very slightly in here. If I'd changed this one here, let's say to 1,200, so instead of 1,000 in here, I put in 1,200. Then of course I'll be getting 600 in there. 5,500 there would still be there. And I'll be getting 6,100. And what we might do is to say, well, project 1 yields 6,100 expected value. Project 2 yields only 6,000 expected value. And you might therefore go for project 1, which still has a chance of making a very poor return indeed. And if the cost was 4,000, then of course we're making a loss there of 2,800, which again could be fatal. So be careful about expected values. Once a project becomes more involved, and in particular once you have maybe something happening in year 1, and then what happens in year 1 determines partially what happens in year 2 and so on, you have to choose really to use what are called decision trees. They still use expected values, but it's a way simply of mapping out what happens, and so we can keep track of where we are on the decision tree. There are two symbols, a decision point where we can decide what to do, and a chance point where we're in the hands of fate. So here we have a little project. Initially costs 5 million. An income on the first year will either be 3 million with a probability of 0.6 or 2 million with a probability of 0.4. Ordinary kind of expected value stuff. At the end of the second year, we have a choice to make. We could upgrade the project for 2.5 million, in which case income would then be 6 million with these probabilities, or 3 million with a probability of 0.3, or we could decide not to upgrade, in which case the year 1 income, whatever it would have been, would simply be repeated in year 2. It's simply more of the same. So 2 years, and at the end of year 1 we have a choice to make, upgrade or not upgrade, and that will determine what's going to happen, or at least partially determine what's going to happen in year 2. So how do we set it out? Well, going through it nice and slowly. Now we have a decision to make, either to not invest or invest. If we invest, then we spend 5 million. And then we sit and wait to see what unfolds during year 1. And there was a 0.6 chance of high income of 3 million and a 0.4 chance of low income of 2 million. That's simply repeating this first paragraph here. A 0.6 chance of 3 million or a 0.4 chance of 2 million. At the end of year 1, we decide upgrade or don't upgrade, and we can make that choice irrespective of what's happened during year 1. If we upgrade, there's a cost of 2 million, or we don't upgrade. Upgrade or don't upgrade. If we don't upgrade, what happened in year 1 is going to be repeated in year 2. Similarly down here, what happened in grade 1 is going to be repeated in grade 2. If we do upgrade, then we can get income here 6 million with a probability of 0.7, or low income 3 million with a probability of 0.3, and similarly in this case here, high at a probability of 0.7 or low with a probability of 0.3. That is really just repeating what's in here. So this was setting the project out, going forward on a time basis, always thinking, am I faced with risk and just chance now, or is it something where I have to make a decision? Then what you do, I've just labelled it ABC up to F, then what you do is you come back through the project, going to each of the split points, little nodes in it, little by little. So if you look at E here, the expected value of E is determined by these two. So it's going to be 0.7 times 0.6 plus with a 0.3 chance getting 3 million. Comes out to 5.1 million. And to all intents and purposes, we can put 5.1 in here. Okay? It's as though this here was simplified down to the 5.1. Similarly, when we come back to C here, we have a decision to make. So if we don't upgrade, we're going to get 3. If we do upgrade, it's going to be 5.1 minus 2.5 in here. It's going to be 2.6. So we're faced with 2.6 or 3 million, and obviously we're going to go for the 3 million. And really we're deciding that an upper point there can be, to all intents and purposes, ignored, and really what we're getting in here is 3. We go back to F now. It's exactly the same as we got in E here. A 0.7 chance we're getting 6, a 0.3 chance we're getting 3. So it's going to be really 5.1 in here. And then when we come back to D, we can see before us either we get 2 million coming in if we decide not to upgrade, or we're going to get 5.1 minus 2.5 net income in there of 2.6. So we have 2.6 or 2 and 2.6 wins. So really we're not interested in that at all, and we've summarised this down to 2.6. Nearly home and dry. The final stage is to get ourselves back to B. B is a chance point, and what you must remember is that this chance here of 0.6 governs everything coming down that route. So it's a 0.6 chance that we get 3 million in year 1 and then another 3 million in year 2. Similarly, the 0.4 chance here governs everything down this line, so it governs the chance of getting 2 million here, plus 2.6 million there. So at B, it's 0.6 times 3 plus 3, and it's 0.4 times 2 plus 2.6 there. It's going to be 5.44. So this point B is 5.44. When we get back to A, really our decision is do nothing, earn nothing, lose nothing, or spend 5 million with this prospect of earning 5.44 million, so profit of 0.44, and the decision would be yes, go for the project. Going for the project, this 0.44 we're getting in here is better than doing nothing. Remember, however, that the whole thing could really turn to ashes. What we could be doing here, we go for the project and we get low income. The choice then was at point D to upgrade, if you remember. We spend 2.5 million, but there is, of course, a chance that after spending 2.5 million, we only get 3 million. So if that happened, we're going to get 2, and then it's a minus 2.5. We spend it there, and then we only get 3 coming in. We're getting in there, and that's going to be simply 2.5 million. So we spent 5 million to only get 2.5 million. I mean, it actually turns out to have been, in retrospect, a very bad decision. If with bad luck, followed by bad luck. Of course, it could easily go the other way. We could have got 3 million in here, and then we decide not to upgrade, I think it was, at point C. Point C says not to upgrade. We get a 6 million. Not in point D. Should be up to upgrade in part C, I beg your pardon. Point C not to be upgraded, we get another 3 million there. We could come out really well. We come out with 3 million plus 3 million from here. 6 million was spent, 5 million. We'll be making 1 million. So again, it suffers from the old problem of just simpler expected values. We're really having income here going from 2 million at the lowest to 6 million at the highest, but that's kind of been lost in this expected value of 5.44. Finally, I'll just remind you of, again, scenario planning. We have looked at it before. If you have a number of different variables going on, different uncertainties, probabilities going on, it's very easy to very quickly get an awful lot of permutations. So here, for example, I've kind of postulated that over the next couple of years, either government 1 would be elected or government 2 would be elected, and interest rates could either be 5 or 7. And then immediately we have got 4 possible permutations of government 1 high-low interest, government 2 high-low interest. And what scenario planning looks to do is to get a viable set of outcomes which are likely to happen together. So if we knew that government 1 was going to be high spending, having to borrow a lot, then interest rates will probably go up. That is a kind of viable scenario. If we know that government 2 was much more for austerity, for keeping government control under a very tight rein, then interest rates might stay down. And we really only have to look at 2 viable sets of events coming up, and this greatly simplifies the amount of planning which we have to do.